At Trimble, we care about connection. Connecting technology, connecting solutions, connecting you. We're developing an ecosystem for transportation professionals that improves every facet of moving freight. Whether you need to improve safety, efficiency, or compliance, Trimble has you covered with telematics and fleet management, route optimization, asset maintenance, and transportation management. Wherever you're headed, your journey starts with Trimble.
Welcome back to Loaded and Rolling. I'm Thomas Wasson, now trucking analyst. That's right. The more I move up in the world, instead of enterprise trucking carrier expert, I've instead shortened it, and now I'm just a trucking analyst. Congratulations to me. We could not afford the birthday confetti, but it's been a wild ride. This is our first live show here for November. We do a little bit of pre-recording. I say we do it live, but I like to spice things up. It's kind of had a lot happen. Of course, we've had the traditional peak season, a presidential election, and overall potential dramatic changes to the supply chain. There's a lot to talk about. And so I thought, let's talk to the folks at Motive. They write reports. They have things such as a Outlook. They have their monthly economic and market reports. And so we're going to be welcoming on Hamish Woodrow. He's the head of strategic analytics at Motive. And Hamish, I feel like we have a lot more to talk about since the last time I've spoken to you.
Yeah, are you able to hear me now?
Yeah, you're good. No copyright infringement
Perfect.
with Verizon.
All right. Well, great to be on the show. Thanks a lot, Thomas. And yeah, just coming. You were just showing the retail index and a few of the slides and also what's happening from the Mexico-U.S. border. And I think one of the key things that we see in the holiday reports is really a pretty positive signal coming into the end of the year. If we've got a red line here, that's the 2023. We're significantly above the 2023 index already in 2024, and we haven't even started entering into the peak period, which is really starting now. Like this week, the previous week, we've really started to see a ramp up in volumes. And when it comes to what we look at is we're looking further up in the supply chain. We're looking at these vehicles going into distribution facilities before they're hitting the shelves. What we see is inventory managers, purchasing managers are really positive on their buying trends in terms of bringing inventory in. And so that's where we're at just now. And we even see it on the cross-border side. Laredo, obviously, one of the biggest land import stops in the US, with about 40% of all traffic coming in through that border point. We're seeing a 30% year-over-year increase in the total trucks passing that border, and the activity is really pushing up. And we actually expect a couple of things. We really expect the next couple of weeks to be very strong, pointing into the end of the year, and we actually expect that to continue into next year, given uncertainty on the import side around strikes that are coming up, as well as any tariffs in the future.
That was one of the things I was curious about because there'd been commentary on the surge in strikes. I mean, the surge in import volumes leading up to and before the strike. So naturally, if I'm ordering things, I want to get it in there before that strike. Strike gets pushed back to January, where there's temporary deal, got to actually make a deal. Is that something where we're going to see a potential double whammy because of also the uncertainty around potential tariffs and stuff like that?
Yeah,
Is that one of those concerns?
that's exactly what we're seeing. So if you think back, the Port of LA, for example, in July saw 60% year-over-year increase in imports, and part of that was some early restocking coming into the end of the year, but also a lot with what was prognosed to happen on the East Coast. We still see imports overall being very strong on the West Coast, and so what we see is typically we would have passed peak season from like an ocean imports point of view. We actually see it continuing through. I think there's a lot of uncertainty at play for people who are out there having to run businesses, having to buy inventory in. Uncertainty is not great. And so therefore the surest thing you can do when managing your business is start to prepare in advance. And so a lot of businesses are going to start bringing in additional inventory. that'll help them manage sort of any both macro uncertainty as well as any sort of changes in tariffs or political uncertainty as well. And so I think that essentially the lever that most businesses have is how much inventory you have in stock. You already see with the latest numbers coming out for the inventory to sales ratios, they continue to climb. We expect them to continue to climb from relative historic lows. They already hit 1.31 last month, up from a low in March of 1.27. So we continue to see this trend of increasing your inventories. It's the only thing you have in your control, and we're going to see that, I think, continue through this year, as well as diversification of your supply chain, trying to not be overcommitted to one location. And that's been a long-term trend since 2017.
And I think that's interesting. You had a really good point on the report itself. The supply chain disruptions are becoming more frequent. Diversifying retailers account for often 30 to 50% of their annual revenue during the holiday sales, and so we're seeing that tick up because there's a big conversation. Some folks say, well, retailers are going to hold back just in time. Truckload capacity is plentiful. I don't have to worry yet. But it looks like now with the changes upcoming, you think that'll even continue to creep up higher? Is there kind of a point of reference before the pandemic, or what's the closest thing I can think about in terms of this retail situation? Because it does feel like in the middle of it, the too much fluctuation from 2020 to 2022.
Yeah, absolutely. And so I think we're going to expect to go back to sort of 2018, 2019 period of pre-pandemic. We're still far below those levels in terms of inventory volumes. So, what the retailers have been able to benefit from for the last couple of years is with the freight market and overcapacity getting relatively cheap freight to move around the US has been kind of plentiful. That dynamic's going to change, and it's already going to change through this holiday season, and that'll tick up some rates. You already see it in a lot of the numbers that you share out, Thomas, on tender rejection rates, etc. So we're going to continue to see a trend that the market is not going to be as plentiful with and the ability to run as lean as they have done over the last 22 months is just no longer going to be possible. And that you add on top of that the economic uncertainty, the macro uncertainty that just seems to be every quarter we're getting hit with a different news story. Inventories are going to have to start to climb up unless companies want to really take a lot of risk. And I think the other thing that they have to play is where they're getting the inventories in from. And so I think this is what we'll see coming through into 2025. It's going to be interesting to look at it. I think the trends that we already highlighted in the report will be continuing. I expect that we won't really have a normal dip going into the start of Q1, where we normally see a lot of dip. I think we're going to see actually a lot of strength in that. And I think that actually a lot of people who've suffered through the freight recession bodes well for demand actually continuing and not having a major dip going into Q1, just with a lot of the uncertainty and need to bring in inventory ahead of sort of Q2 next year.
And I'm looking at your retail grouping. I'm a big fan of retail grouping. Some folks will argue that manufacturing heavily impacts truckload more. I personally feel like it's a little bit more nuanced in the full truckload space because you're competing with LTL and other ones. So there's always the question of what mix constitutes what. And so one of them that I thought was wild, your sentiment index for home improvement compared to 2023, we're up 47.6%. I don't think it's a hurricane, or you think it's that same import thing where we're seeing the supply chain making the adjustments?
Yeah, so it's a tale of two stories. One is where were we last year at this time of year? So that's always the point. It's like relative last year, if you remember, in end of 2022 and 2023, the theme was retailers had too much stock. They built up a lot of inventory. They continued to forecast demand growing in a similar way to the pandemic, and that didn't realize, and they ended up with too much inventory on their books. And with the cost of capital out there, the cost of holding that inventory, it became really important to reduce that inventory. What did that mean? Less imports come in, less trucks go into distribution centers, less inventory. And so that was kind of where we landed last year. And so what's happening now is we're seeing two things. We're seeing a more normal inventory to demand replenishment cycle. And we're seeing these uncertain events coming up that retailers are having to bring in inventory earlier, and the supply chain is not as lean as it was 12 months ago, let alone 24. So they're really having to cope with all these things, which is really driving up that home improvement index. And so that's where we're seeing home improvement will have a strong period of time. They have home improvement is one of the most interesting sectors where you actually kind of have several holidays during this period that cause spikes in inventory. You have Halloween that were just passed. We're coming up to the Thanksgiving period, and then we finally have the Christmas period. And these kind of three spikes cause large changes week over week in the number of trucks coming in. And we've seen real strength coming into the first of those peaks year over year. It's not quite what we've seen in previous years back in 2021. It's still pretty strong, and all these factors are leading us to believe that at least the retailers are preparing for a pretty strong holiday season.
And I have a theory, I have a hunch here. I love your retail index because having geofence data as a telematics provider, you can capture the moves. One of my theories is, especially in the home improvement and retail space, is the home improvement space. If you look at moves by Home Depot, who purchased a large private open deck carrier. Now Home Depot is like one of the top 50 largest private fleets in the country as of 2023. I'm wondering about, as we're seeing some of these trends, because people ask me, well, Thomas, how come it hasn't gotten into the general market? The impacts of a private fleet growth versus the for hire, because since 17 as well, according to the National Private Fleet, NMFTC, they know who they are. They're talking about how they had put in place this growth pattern, and even in other areas like your Dollar Generals and stuff. Is that something that you guys, especially looking at the data, is that something in the future? Because I feel like you can cook with a private fleet versus for hire per unit of arrival.
Yeah, and we cut out the data in different components because, at the end of the day, what this data helps us do is have a better understanding of what's happening in the market. It allows us to tell our customers what's happening in the market based on our information. And so we actually look at the for hire space overall, specifically. So I agreed on, like, there's this interesting trend around the private fleet growth, but also on the for hire, I'm actually seeing a lot of in splitting out the data from the retail index, we see actually a good strength in the for hire space in terms of movement, in terms of the loads that they're getting demanded to go to these, especially in certain retail sectors. We call out grocery and superstores as well as department stores and apparel. They're seeing like 20% plus, 27% year over year increase in terms of the number of truck visits. And a lot of that is being driven by for hire. A lot of the growth is actually being driven by small, medium-sized businesses coming back in the space. So I feel like although we've not seen the fundamental prices change in the market yet, we're seeing a lot of the core fundamentals actually change in terms of what the retailers are doing on their side. They have a really strong demand trend that is influencing the for hire space and influencing small and medium-sized businesses. And that's where we really put it out in the report, that as we come into this holiday season, as we come into this time period over the next couple of weeks, we're going to start to see finally some pricing movement, some pricing changes. As just the demand for freight continues to be relatively strong, but the capacity is not there anymore. We've lost over 50,000 carriers over the course of 2024. It's a huge amount of exits from this space. And we just feel like we're in that balancing phase and just waiting for that price to start bumping up.
That brings me to a chart. It's the median age of existing carriers. It has risen to its largest level in 3 years. I think this is such a cool chart because one thing that we talked about with the great capacity exodus, the ones who are surviving, we're slowly seeing like this return back to a more historical, typical average. Do you think right now that it may actually uptick closer or more? I think we're right around that 3, approaching that 3.25 for an average age. What are some of your thoughts as we're moving up? Is there a potential that we see another high and then it goes back down as 2025 gets through?
Yeah, so I think what we'll probably see is this continue to climb, just essentially carriers that have been in the market for a long time and suffered an extended freight recession just run out of cash. And there's still a limit to the amount of credit that's out there, and interest rates are still relatively high. So it's still a tough environment for carriers. And so we'll see this tick up as just older carriers just no longer have the balance sheets to sustain businesses. And that's what I expect to happen, at least through the beginning of 2025. But at that point, I feel this is a good metric to show the reversal in the market and from where we've come from. That dip that you saw at the start, we went down to about 1.7 years, the average age for a carrier exit. That was this glut of capacity that just came in during COVID, when we had very high rates and still relatively low operating costs. We hadn't been hit by inflation yet. We hadn't been hit by a lot of factors. And then when you saw the market turn in 2022, those carriers just exited. The youngest carriers just exited out the market, and this is a 10-year trend, and we've never had an age like the average age of carriers being below 2, and so this really just showed that glut that was leaving, and the fact that we've climbed up is meaning that we're going to back to a more normal stock of carriers that are going in and out of businesses, closing up shop, maybe retiring, maybe changing their business types. That's what we're going back to just now. We still expect a little bit of suffering as we get to the tail end of here, and that essentially the balance sheets just don't support the business's continuity. But we really feel that we've hit that reversal point. You can see those metrics are back in line with where they were pre-COVID. And a lot of that is just telling us this market is really just in a move back to a more normal phase. We still got a lot of uncertainty out there, but at least the carrier makeup is back to a more normal phase.
And I think this is really cool. I wanted to highlight one more. This is the drives up hours of service. It's a chart on hours of service. Holiday season, typically it sees a higher amount of hours of service violations because you're in a hurry. You're working under harder conditions, traffic patterns, and stuff. This is fascinating because I wanted to kind of dovetail into we're seeing the nature of the carriers return to normal, but from a safety standpoint, compared to previous cycles, is this something that could potentially speed things up because higher insurance costs now table stakes are dash cams and telematics when before we were just happy to send someone a text message? What are some of your thoughts?
Yeah, absolutely. And this is one of the points we highlight in the report is as we get into the holiday season, obviously there's a lot of economic information out there, but actually safety becomes something that we really concentrate on with everything that we look at. And so, the holiday season is the most risky time period on the road. We see more than sort of 32% increase in crashes across the Christmas period, especially Christmas Day versus the rest of December. We see real big spikes in the number of crashes occurring during this time. Hours of service is a good reason for that. We actually see through December the rate that a log is out goes beyond their hours of service, and the driver is in violation goes up during those initial weeks of December. There's a lot of pressure on the driver. We see increases in speeding across this time period as well, and there's a lot of pressures on drivers, and that leads to more collisions on the road. And so what I do think for the long term is the mass adoption and real widespread adoption of dashcam technology, specifically AI-enabled dashcams, is really going to help reduce the collision rates over time, and hopefully we can really have a reversal going into this period of time through 2025, and that'll ultimately allow insurance premiums for at least the best carriers to start coming down. And so it's important, with everything we talked about at the start of the show, which was a lot of needing to defend in these economic uncertain times. You have to look at what's within your control. Safety is one of those things in control for fleets out there, and that's what we are looking to concentrate here on the safety side.
And I think it also shows also trying to decrease not only safety on the road, but decrease cargo theft, instances of fuel skimming, and other things. So fleets are having to adopt more and use more technology. And I wanted to grab some thoughts because I had a few. This one I've been kind of noodling around here is that as we're moving forward, the higher demands on safety placed on carriers means that more attention is given to things such as inspections, accident records, and everything else. Will that be something that as we're coming into 2025, theoretically, could that be something that would speed up reaching a balance point, if that would, like, for instance, push it over quickly, or will we see a gradual upswing? What are some of those thoughts? Because I have a theory that the safety aspect and brokers facing potential more liability means that we may swing this thing a lot faster because we have so much more expectations placed on everyone.
Yeah, and I think that what we'll see is probably a little bit of a fragmented market coming into 2025, where we see still strong demand in terms of moving things, but there's still a choice out there, and there's also higher demands put on carriers, and so what we'll see is that the best carriers, and this is what we've been saying throughout this period of time, that the best carriers will be the first to benefit during this period of time, especially in the small and medium-sized space. What we'll see is a lot of medium-sized mid-market businesses will be able to grow substantially as rates start to pick up, and that the demand remains constant, and that you can really go out there and command better rates. And you'll also be able to bring into this period much lower operating costs. The best businesses will be able to go out there, and they've spent the last 24 months really concentrating on squeezing out as much margin out of their business as possible, because they've been in a really tough rate position. They can maintain those operating costs, they can maintain their safety across their fleets, then they're going to be the ones that profit the most during this period as rates go back to a more normal level, and they'll be able to reinvest and grow their businesses. And that's where we're going to see through this period of time over the next year. I think you're going to see a number of mid-market companies go out and start playing in the enterprise space, especially those that are able to adopt technology, because they're going to be able to move quicker. They will have less barriers to entry because they'll have less existing systems, and we'll see them be able to grow really during this period of time. And you'll see that in the course of 2026, where you'll see a lot of new players out there that have been able to promote themselves into the next league.
That's what I think. Being a freight broker and a carrier, I'm excited for this because you mentioned that more smaller to medium sized carriers entering the enterprise space. When I started in 14, we used to joke Home Depots and P&Gs wouldn't give you the time of day. It used to be like 331, three asset based carriers and one broker for a routing guide. And so, is that something looking ahead? I have a theory that brokerages are going to be in trouble because those very carriers that they were courting, who were safety oriented, well ran, had their cost under control, or be maybe the first ones who say, well, we're going to take another brokerage that gives us another deal, or now we can finally get a better deal. Is that kind of that new future as well? We're going to see these smaller tech savvy carriers getting more of a share, but it may also bite those same brokers in the butt who are making RFPs on the handshake agreement.
Yeah, I think this is one of the areas I'm going to observe a lot over the next 24 months. I think as you move, we've been such a long time in this doldrums in freight, and a really tough period of time. And so actually seeing what is we've really passed more than 5 years in a very unstable environment. And so now as we move out of that period, and we're going to see a real boom period coming towards us, what's going to be by the end of 2025, the change in the dynamic? I think a couple of core themes. Technology is going to be fundamental across the best carriers. You're going to see the ability through visibility into your cost of the fleet, how you operate, your utilization of your fleet, your safety of your fleet, where you're spending money, where fraud is occurring. The better you are able to manage your costs and maintain them at low level as you scale, is going to see the best carriers really be able to profit during this period of time. And I think that's where you're going to see the winners come out. And there's just so much that's changing in this space that's going to enable them. And that's really where I'm concentrating most of my time in reading, at least.
We got about 2 minutes left here. We went a little bit over to offset. When we're looking ahead, do you think tariffs, yes or no? That's my hot button current event. Will the tariffs be the impact, or were we already structurally set up that, it's just a matter of how fast if we're going down this slope in the upswing?
So I think people have to prepare. You're running businesses, you got to prepare. So you got to prepare for uncertainty happening there. So I think you'll see businesses already start to bring in inventory from next month in preparation for tariffs coming. I think the second thing is the market is fundamentally different than it was in 2017. This change has already started. Diversification of your supply chain is a requirement now. And I think where you used to see exceptional concentration of people's supply chains to specific geographies as well as specific routes, that's just no longer an operating practice that large businesses can sustain. And so what you're going to see is risk mitigation. And so you're going to see continual investment in different geographies for a supply chain. You're going to see different modes get invested in. And I think that's where you're going to continue to see growth in south of the border with Mexico. You also see other geographies become more important. It's just risk mitigation as you go through these periods of time. And this is just a continuing trend that already started almost a decade ago now.
So better safe than sorry, but it may cost a little more.
Yeah.
I love it. Thanks so
Good
much
summary.
for coming on, Hamish. Folks
Thank
want to
you
learn
very
more,
much.
get in touch with Motive, check out your reports as well. What's the best way to find out more?
Yeah, you'll be able to find all our reports as well as information on Motive at gomotive.com.
Perfect. Hamish, thanks so much for your time. We'll catch up again soon.
Thank you. Bye for now.
That's going to be a wrap for today's show, but if you're just joining us, we'll be on demand, Apple, YouTube, Spotify, wherever you may find your podcast needs. And if you want to check out my newsletter, FreightWaves.com/loaded and rolling, I write things. That's right. New title and more expectations. Check it out. Sign up for it. Give it a go. Check out the folks at Motive as well. GoMotive.com. Good people. Always amazing information. Great tech as well. That's a wrap for this show, but join us next week. We'll do it live.